Earlier today, November 22nd, I published a new post discussing my trades over the past few days. A link to my blog post can be found in my profile page here at YouTube. I am primarily a bond and treasury bill investor now, since my primary objectives as a retiree are capital preservation and income generation. I do own mostly dividend paying common stocks and some preferred stocks as income alternatives to bonds and treasury bills, but an overall exposure is very light, somewhere close to 8% of my total assets held in brokerage accounts. I will generally own between 200 and 250 dividend paying stocks, so I'm spread out pretty thin. Since I am anticipating a decline in my interest income next year compared to 2025, based in significant part on lower yields from treasury bills purchased at auction, and I bought 40,000 in treasury bills last week, I've been increasing my purchases of beaten up dividend paying stocks. By beaten up dividend stocks, I'm referring to a stock like Clorox, which hit a new 5-year low last week. And at the low price, the dividend yield went over 5%, as I recall. The stock market rally yesterday, November 21st, 2025, was sparked by the comments made by the Fed's Vice Chairman, John Williams, who is president of the New York Federal Reserve, where he said that a further adjustment in the federal funds range was needed in the near term, and that was interpreted to mean at the early December 2025 meeting. He noted that his concerns about a weakening job market was more pronounced than concerns about inflation. The concern about the weakening U.S. job market is justified by all of the evidence and was reinforced with what I would call a weak October jobs report released last Thursday. I do not foresee a rate cut, however, as a cure for what ails the U.S. economy now. The economy is simply not generating anywhere near the number of jobs necessary for new entrants to the workforce to find a job, which includes those graduating from high school or colleges, as well as those who are currently unemployed but are still looking for a job. In the last jobs report, the very poor numbers for July and August were revised down, with August going from an extremely anemic plus 22,000 to a negative 4,000. There are also an increasing number of job layoff announcements and these are major job layoffs from companies that like Verizon, Amazon, and many others. There are also an increasing number of new entrants into the workforce looking for jobs. Goldman Sachs estimates that there will be 50,000 job decline in October due to in significant part to the federal workers who received buyouts several months ago that paid them through September even though they weren't working. No longer being counted as employed in October. The BLS is not going to release a complete October report, jobs report, and will not release the November report until after the Fed meets in early December. If there had been no government shutdown, the Bureau of Labor Statistics would have compiled both the CPI and the PCE inflation reports for October that the Fed would have when making a decision on interest rates, but there will be no inflation reports for October, and the November data will not be reported until after the Fed meets in early December. So the inflation numbers, which may have caused some Fed sitters on the Fed to wait before cutting again, will not restrain those voting members, and that makes a 25 basis point cut more likely. The odds are currently at 71% for a cut, according to the CME's FedWatch tool. Rate cuts are a two-edged sword, and this is rarely talked about by people advocating for them. The cuts in the federal funds rate starting in September 2024 has deprived investors of disposable income that could be used to fund purchases, pay down debt, high-cost debt, and or to save. That negative result is rarely mentioned by those who advocate for lower interest rates, and I will certainly be receiving significantly less interest income in 2026 than I did in 2025. And I doubt that any rate cuts from an already historically low federal funds range, which is the range now, will cure any of the problems that the economy is currently experiencing, and not enough to offset the economic drag resulting from lower consumer disposable income, resulting from less interest income that will be felt the most by retirees who are also facing a 10% increase in their Medicare Part B premiums next year, along with significant inflation and other non-discretionary purchases. Other problems in the U.S. economy that are not remedied by lower interest rates, in my opinion, include the price increases that are being caused and will be caused by the Republican tariff taxes, and that will reduce discretionary consumer purchases. Supply chain disruptions resulting from the mass deportations of unlawful, undocumented immigrants, and as well as the tariffs. The absence of consumer spending support of the economy resulting from the mass deportations. I mean, these people that are being deported no longer are U.S. consumers. The replacement of workers with AI, which I believe is accelerating now, the high consumer credit card debt levels, and wage growth barely keeping up with inflation now. The interest on credit card debt will not materially be affected by lower borrowing costs for companies. The rally on Friday was particularly helpful to me because it indicated a rotation into the kind of dividend stocks that I have been buying. I intend to continue buying dividend paying stocks in a net amount of 1,000 to 2,000. I'm trying to restrain any sales of dividend stocks until next year. I've already managed to move myself into a higher tax bracket in 2025, and I am buying more treasury bills maturing next year in order to take interest income that would be taxed this year and put it into taxable income in 2026. I do not anticipate changing the approach that I am taking now unless the market collapses by at least 25%, and then I will increase my purchases each week.